Okay, so is the real estate market gonna crash? You've been seeing on the news, the unemployment rate is through the roof. You've also been seeing the amount of people that are starting to claim mortgage forbearance. Why is Elon Musk selling both of his houses? Are we in another recession? And if so, how long is it gonna last? Should I sell my house? Should I buy a house? All right, what's going on, everyone? Welcome back to the channel. My name is Irvin Pena, but you probably know me as Irv Official. This is a channel dedicated to business, money, finance, entrepreneurship, you name it, we talk about it. I wanted to make a video that I felt was not as biased as some of these other videos that I see where they're either completely for market crash or they are completely against the market crash, but rather I wanted to put the information out there so that you can be the judge of, okay, is the market gonna crash or is it not gonna crash? And if it does, how can I prepare myself? And so that's exactly why I prepared this video with these charts to show you the stats, the numbers, and let you weigh the options of whether now's the time to buy, is now the time to sell, should I invest, should I pull my cash out, should I refi? And hopefully you can get better understanding from this video of what's really going on. Nonetheless, this leads to a very popular question that I keep either seeing on different channels or that I keep hearing in my own social platforms, and that's, look, is the real estate market gonna crash? And if it does, is it going to be worse than it was back in 2008? Stay tuned until the end of the video because I let you know what I think is gonna happen with the real estate market. The amount of people that are in line to receive unemployment benefits and that have lost their jobs, furloughed, laid off, you name it, has completely skyrocketed. If you just compare that number to what 2008 looks like, I mean, it absolutely makes 2008 look like a mosquito compared to what this beast has become. Not to mention the stock market. You'll have some days where the stock market is rallying, and then you'll have some days where the stock market is just a complete mess. When it comes to the real estate market, there's a bunch of moving pieces. Kind of like you smashing that like button down below and making sure that you subscribe to this channel if you haven't done so already. Obviously, each sector is different. You have certain cities and certain states that are performing at much higher rates than others. You have real estate markets such as Los Angeles, where even if there is an economic shift, they do not feel it as much as, let's say, Baton Rouge, Louisiana does, because of how much money gets poured into Los Angeles and just how the economy flows there overall. Keep in mind that in 2008 was a completely different beast of what occurred 3, 4, even 5 years prior to the market actually tanking between 2008 to 2011. What led to the market crash in 2008 was really a few moving pieces, which they call the perfect storm. And one of the pieces that caused the 2008 collapse, or the real estate market to collapse, was something called subprime loans. Now, there's two things that happen. One, someone goes out and they try to get pre-qualified for a mortgage, let's say at a bigger bank like a Wells Fargo or a Bank of America. Let's say it's at a 3% interest rate. If they have a lower credit score, or in this case, they had a lower credit score, maybe they had a 600 credit score or even a 550, they perhaps didn't have as much reserves in the bank, the job history wasn't there, and so they were considered a higher risk. Why is that important to know? Because if someone's a higher risk, then that means that the bank sees them as a liability to actually loan money to. And if they're a liability and they actually end up lending the money to them, then it's gonna come at a price. What's the price? They can either pay more toward closing costs, they have to bring more cash to close, or the interest rate is going to be a lot higher. So the people that actually qualified and got loans that were considered high risk ended up getting it through the subprime market. Meaning, instead of, let's say, having a 3% interest rate, they now had a 4.5% or a 5% interest rate. What does that do? What does that do for your mortgage? Well, it makes the mortgage amount higher. So instead of having an interest rate that was comfortable for them, they now had to deal with the fact that, okay, I need a property, but it's gonna come at a cost of obviously having to pay more money on the back end with that higher interest rate. Meaning, instead of paying a 3% through a bigger bank and your mortgage being $1,200, now you're paying, let's say, 5.25%, and your mortgage is now $1,700. Just to put this into some round numbers that we can actually work with. Another piece that led to the real estate market collapsing in 2008 was something called an ARM, meaning an adjustable rate mortgage. Now, what's an adjustable rate mortgage? There's something called a 5/1 or a 3/1 adjustable rate mortgage. It all depends on the lending products that are out there. But back in 06, 07, and even 05, they were doing 5/1 adjusted rate mortgages, meaning that you would get a mortgage at an interest rate that was locked in for 5 years at a fixed rate. So again, working with round numbers, if you receive the mortgage at 3% interest rate, at that 3% interest rate, it would be locked in for 5 years. Now, why is this important to know? Because after that 5th year, headed into year 6, it then becomes volatile, meaning it moves according to whatever the market is that year. And what ended up happening is that interest rate ended up moving for a lot of people, even if it's a 0.5%, even if it's a 1%. A 1% on a $400,000 or a $500,000 property can make a difference of $200, $300, even $400 worth of mortgage payment. And again, those numbers are very conservative, but just to put this in simple terms that we could all understand. And so what ended up happening, you tack on a subprime loan. On top of that, you stack it with an ARM type of loan product. And then what that creates a nice little cocktail for disaster. Here's why. That person that should not have even been in the property to begin with because they didn't qualify, but with loan regulations being so lenient to get people into properties, they now face a adjusted rate mortgage, which moved on them. So now their interest rate is higher on their property, and their interest rate was already too high to begin with for them to even make those payments. And did I forget to mention that appraisals were pretty much a free-for-all, meaning if a property was really worth $400,000, appraisers were writing it off for $450,000, $465,000. And so the next person bought a property and that now they think that their property is worth $460,000, $475,000. So now they're selling their home for $500,000 and actually getting that amount of money for it. But the person that gets stuck in the back end is the buyer that actually bought those homes with the fake appraisal. But here's where this got even more interesting. With that fake equity having been built in to the home prices and the inflated home values, people now decided to take out home equity lines or lines of equity. What is a line of equity? Let's say that your property is now worth, again, $500,000, and you speak to your lender, you speak to your bank. They say, yeah, you know what? We did an appraisal on your property. It's worth $500,000, and you only owe $400,000 on the property. Guess what you can do? You only owe $400,000 on the property, but now you think that your home is actually worth $500,000, so you're not going to sell it. What you're going to do is now pull out $50,000 worth of equity from the built-in equity that you had on your property. So now your mortgage isn't based on $400,000. Now your new mortgage, when you get that new bill, is based off of $450,000. But guess what happened in summer of 2008? All right, guys, real quick, if you're finding any value in this content, I would love it if you guys smash that like button down below. And if you haven't already, hit that subscribe button. Let's get back into it. That's right. The economy collapsed. The housing crisis caught up, meaning the values were no longer what you pulled that money out for. And so now you have this bill that keeps coming in every month for the additional $50,000 of equity that you took out for a property that just lost 30, 40, even 50% value in some cases. And so what did a lot of homeowners do? I'm not gonna pay for this. I can't afford this. This is over my head. I thought this was free money. I thought I was gonna pay $1,100, but now the adjusted rate mortgage jumped on me, and now my mortgage is really $1,600. I can't afford this property. Who put me in here? The reality is that people were not being smart with their money in 2008. They were not using that money to reinvest. They weren't using that money to put back into their businesses. They were literally putting that money to buy cars, to fund their boat, to have some parties, to hang out, to go on that dream vacation. And look, that's fine and dandy, but when you know, or when you have the idea that you don't have to pay that money back and this is just free money, it comes with a price. And so when you just put that money into liabilities and you don't actually invest into more assets, then of course it's gonna be tighter and of course it's gonna be harder to actually pay that money back. There's no more money coming in. And let's put this into perspective, because if we take a look at the amount of money that people have cashed out on from 2017, 2018, and 2019 and compare it to just 1 year of either 2005, 2006, or 2007, it's not even close. But this is where things get different with the housing market in 2020. Here's why. You have companies like JP Morgan coming out and saying, we are only going to start funding or seriously considering loans that are 20% down and have a minimum of a 700 credit score. And I know that doesn't sit well with a lot of people because we believe in the first-time home buyers. Look, I get it. This is a company that learned from the past and that's actually getting tighter a lot sooner, rather than having to sit back on their heels, kind of like what happened in 2008 with a lot of banks going under. If you're an investor, I think that right now is a very tricky time for you. Here's why. There's really no protection for you as the investor from what we've been seeing with the stimulus money and everything going out. It's kind of like a free-for-all. And so now you're having a lot of tenants under the impression that they can just skip out on rent, that they can't get evicted, that they don't have to pay you. But here's the problem. If they're not paying you, and if you're barely breaking even with your investment properties, then you're going to experience what happened to quite a bit of people back in 2008 when they over leveraged themselves with the properties that they acquired in the previous years, again, under those programs and under those inflated appreciation rates. Now you have companies like Airbnb, which is heavy in the vacation home rental type of market, and they just laid off 25% of their company. And the reason why I say that travel is going to be slow to get back is because you have people like Warren Buffett who sold pretty much all of their airline stocks. If you're in a vacation rental market like Miami, Orlando, New York, places like that where there's heavy flows of traffic of people that are visiting, then you should really be concerned of what's going on. Here's why. The travel has significantly gone down, and that is something that affects a vacation style rental market or rental type of investing, because obviously if there's no one coming in, there's no one to actually rent that property to. And so if you live in an area where there's no way that you can put a long-term tenant in there, then in that case, I would consider possibly getting myself out from under that property and getting my cash out. Look, even if you take a loss on it, just because I think that things are going to be very slow when it comes to people actually traveling again. So I'm about to make a bold statement. There is no correlation between a recession and a housing collapse. Now, I think that the word recession gets thrown around quite a bit and people don't really know what it means. And look, a simple breakdown for the word recession and what it actually means, it's 2 consecutive quarters of a downward GDP, with the exception of the 2007 to 2009 housing crisis, also known as the Great Recession, and the Gulf Recession from 1990 to 1991. Every other recession that we saw had no direct impact with home values and the housing market itself. Looking at this chart right here, we have the existing home sales, which is in the blue. You have unemployment rate, which is in the yellow. And then you have red, which is the mortgage availability. So with the exception of the 2008 crisis, and the reason for that is because mortgage availability already had tightened up. And so that's why you see the unemployment rate going up while the housing prices had gone down. But check that out, in 2009, they had gone up. And same thing happened in 2015, and same thing happened in 2014. You have companies like Goldman Sachs coming out and saying that the downturn is going to be 4 times greater than the housing crisis, but there is going to be a bounce back. Looking at this chart alone, you can see where their prediction is that yes, the recession will be deep, but the length, meaning how long it actually lasts, it's going to bounce right back. And so the predictions, again, assuming everything goes back to normal with everything opening back up, is that the 3rd and 4th quarter is going to be stronger than the first 2 quarters. And immediately, just like that, you're out of a recession. Because remember, people losing their jobs wasn't because these companies were going under. It was something that we had never experienced before. And so it's not a question of are those jobs going to be available for people when they get back. It's a matter of how soon can we get those people back into the jobs that they lost. In fact, looking at this graph right here puts us into the mind of the top 50 industry leaders. You have 66% of them voting a 1-month bounce back, and then you have another 90% of them voting a 1 to a 3-month bounce back. There is no correlation between the unemployment rate, home values dropping, and people losing their homes. Wait a minute. What did you just say? You heard me. And look, I know what you're probably thinking. You're thinking, okay, well, Irv, the unemployment rate is through the roof. It's way higher than it was for 2008. What, does that have anything to do with what's going on? Yes and no. Here's why. Going back to that V shape that we saw, where there's an expected spike, again, what they're hoping for with the GDP, then obviously there is not going to be a housing crisis. But assuming that everything works out as planned, even though we had that sharp dip, we're also going to expect a sharp bounce back. Brings us to our next point, and that's this. Nearly 54% of Americans already have 50% of equity built into their home, so that's a nice cushion. You have 30% of the homes across America that are already owned free and clear, and just over 26% of Americans have at least 50% of their equity already built into their mortgage. I will say this, I came across this article with Zillow that the home sales will drop 60% and home values will drop about 2 to 3%. I do agree with that statement. I think that we will see 2 things happen. One, we're going to see a slowdown in appreciation that we've been seeing over the last couple of years. And 2, I do think that in some markets, we will see a slowdown in terms of how fast and how quickly homes are actually coming on the market and coming off the market, hence that 60%. But the 60% does not mean that that's the actual price drop. That just means that it's taking homes longer to sell We know that if it takes a home longer to sell, then obviously there could be less money on the back end for the seller compared to a 20, 30, even 40% dip. I mean, I'll take the 2% dip all day. Another interesting difference between the housing market in 2008 and 2020 is this. You have something called the annual home appreciation rate. And so let's take a look at the first 6 years leading up to the 2008 crisis. So if you see 2003, that big spike in 2004, and then again in 2005, headed into 2006 is when we saw that the mortgages actually, or the mortgage lending actually started to tighten up a little bit. And so once that began to tighten up, that's when you see kind of that fall off happening and the amount of homes actually coming on the market and the amount of mortgages actually being sold. Let's take a look at the last 6 years headed into 2020. Look at 2018 and 2019, 4.8 and 4.7, and then compare that to all the years leading up to the housing crash. For everyone that's been complaining, saying these home prices are too high, these home prices are too high, they have to come down. Let's put that into perspective, because we just saw the last 6 years prior to the housing crash compared to where they are now. So it helps you appreciate where the real estate market is now compared to where it was then. Another key difference that makes these markets totally different is where the 2008 inventory was and where the 2020 inventory currently is. Now, there still is a shortage in inventory, meaning you have markets like New York that are right around, and when I say New York, I mean New York City, that are right around 12 to 18 months. They're well into a buyer's market. But then you have markets like Orlando and California that they're still running less than 45 days, which is barely 2 months of homes on the market. And that, to me, is still considered a pretty hot market. If you're an investor and the market tanks, then obviously you're going to be buying properties for penny on the dollar. If you are a first-time home buyer and you've been saving up your entire life for that moment and the market tanks, you're going to be picking up for pennies on the dollar. But if the market doesn't tank and things just continue to go where they are, and we see that cap bounce that's being predicted, and everyone goes back to, let's say, their jobs and more stimulus money comes out, then none of this even matters, because we're not going to be seeing prices dip as much as people really think they are. And let's be honest, if the prices dip 2 to 3%, is that really going to make or break the bank? I mean, look, 3% of a $300,000 house, that's only $9 grand. Let's compare it to what was happening in 08, where prices were dropping 20, even 30%. That right there is a bargain. And so my suggestion is still do your homework. Understand that no two sales are exactly the same and no two markets are exactly the same. And so whether you're an investor, a first-time home buyer, or you're just looking to get your cash out of your property, make sure that you contact a professional real estate agent that can actually walk you through that process and that actually understands the market. And there you have it. I hope that you enjoyed this breakdown of what I think is going to happen with the market. Let me know what your thoughts are down in the comments. If you think that the local market is going to collapse where you're at, if you think we're going to go into a global recession, I love hearing back from you guys, different opinions, different thoughts. I always get so much encouragement from you guys on the videos that I put out. So I do this for you guys. And if you haven't done so already, hit that little bell up top so you can get notified every time I'm dropping new content just like this each and every single week. Smash that like button down below. Hit that subscribe. Once again, everyone, my name is Irvin Pena, but you probably know me as Irv Official. Until next time, everyone, we'll see you.